Joining us in studio today is Hiren Ved, Director and CIO of Alchemy Capital Management. Hiren, very warm welcome.
Thank you so much. Thanks for having me again.
Oh, and great to have you at the NDTV Profit Studios as we ring out 2024 and hope for maybe an equally good time in 2025, not the last 3 months, of course. I want to start with exactly that point. This realization dawning, or perhaps this narrative right now, that what we saw in the last 3 years was unusual in terms of the ferocity of the bull market, and it's time to be more realistic about what returns you can get from Indian equities. Are you in that camp as well?
Yeah, I mean, last 4 years since COVID, from 2020 to 24, were exceptional in the sense that nobody knew that, post-COVID we would have such a significant revival in earnings growth in India. I've been at pains to explain that, people generally hang their hat that this bull market is driven by domestic liquidity. Obviously, domestic liquidity is very important, but Nifty earnings compounded at 25% those 4 years, and the broader markets, the NSE 500 earnings compounded at a staggering 35% plus. That's why we saw the ferocity and the breadth of the market was very, very good. But now in the first half of this year, we've hit a little bit of a patch where earnings growth at a very broad level is down to flat, right? And therefore, given the fact that valuations were not exactly cheap, and the fact that we've hit a little bit of a speed bump in our growth trajectory, means that the markets need to pause, consolidate, before we see recouping some of that earnings momentum. So I think, to be fair, the economy lost some momentum in the first, second quarter. I think the markets will wait to see whether we regain that momentum, both in economic growth as well as in earnings growth, right? Because, as we all say, that markets are a slave of earnings in the end of the day. In between, there are always narratives, so, we can have good fun, but I think the reckoning comes every quarter when the earnings numbers come in. And then the markets have to reconcile with that. So, yeah, I think we shouldn't complain. We've had a great 3-4 years, and we should probably pause a little bit, consolidate a bit. And if the earnings come back, let me tell you, even before the earnings come, the markets will signal that to you, because typically markets tend to get a whiff of that much earlier.
Oh, that's true. That market intelligence and that collective intelligence is definitely there. Just on that point of the last 3 to 4 years have been very good and we shouldn't complain. Hiren, you're coming from the perspective of someone who's seen markets for decades.
Yeah.
My only point being that a lot of people in the markets right now have not had that experience. Reality to them is the last 3 to 4 years. Is there any concern of these investors, who are sizable now in number, fleeing at the first sign of trouble?
Look, I think that if you look at the data, the leader of this bull market is not the institutional investor, is not the FII. It's actually the retail investor who's kept the faith. And then you're seeing that come through inflows into mutual funds via SIPs and so on and so forth. I don't think that they are fleeing. The people who may flee will be the guys who want to come here and do a quick trade, and I think who really benefit from the momentum in the markets that we've seen. And now that the momentum has broken, it's not very easy to make quick money, right? And I think, this kind of speed, as the wise men in the markets used to say, you can either have direction or speed. You can't have both together for a very long period of time, right? So I think the momentum is certainly gone, but I think the speed is, the direction is still up, but we have to get used to now the, earning the hard way. I mean, we are so used to getting returns very quickly. You buy and then you get very quick returns, right? That was possible because the base of earnings was so low and nobody expected that the breadth of earnings will improve so dramatically. And also India doubled down significantly on capital spending, and that revived a lot of the manufacturing plus the geopolitics, and a lot of things came together to give us this. So I'm not bearish, but I think we should temper our expectations of how fast we can make returns. In the good old days, we used to buy stocks. Sometimes you never got returns for 2-3 years, and then you got returns, right? So we've forgotten those good old days.
Yeah. Well, Hiren, I'm guessing you're being a bit modest here, because I'm sure you penciling your portfolios for earnings growth and returns northwards of 15% even for the next calendar, right?
Yes.
So now my question is, for a lot of people who look at the Nifty and don't have a single banking stock in their portfolio, they fail to realize that you don't have to match the Nifty returns, or the Nifty being 5% doesn't mean your portfolio has to grow only 5%, right? How is your portfolio position currently, Hiren, for making the best return based on your hypothesis of what will happen to earnings in calendar year 25?
So I think, clearly we are very different from how the index is structured, right? And this is not today. I mean, I think since late 21, early 22, we had significant exposure to where we think the growth was. And I'm sure we spoke about the whole manufacturing theme. And we can see that certain sub-segments within manufacturing have stood out, electronic manufacturing being one of them, but also capital goods, power transmission. A lot of those areas have done phenomenally well. We still have a bulk of our positioning in those areas because I do believe that these trends typically last for 6, 8, 10-year cycles. They are not 2-year cycles, right? So if we assume that 2020 and 21 just went away in shutdown and open up of the economy, really from 22 onwards. So we are just 2.5 years into this trend. And I think that this trend is likely to last much longer. So our positioning has remained that. But along with manufacturing, we also have a fairly strong exposure to high-end consumer discretionary, or things where premiumization is playing out very well. So liquor stocks, we do have exposure to capital market plays, exchanges. We don't have any exposure to banks. As I have said, we stayed away despite very popular consensus that private banks is the place to be. We just believe that this is a cycle where credit growth is moderating, deposits are difficult to come by, and also this was a space which was over-owned. And therefore, I had a very simple commonsensical that if the average household saver is moving away from deposits to SIPs, why should I be in banking? I should be with the capital markets guys, right? And I jokingly tell a lot of my friends who are very bullish on HDFC Bank, and I told them that you would be better off buying HDFC AMC rather than buying HDFC Bank if you want to be within the group, It's a great brand, great franchise, but just swap from the bank to the AMC because that's where the money is coming.
Yeah, that's
right?
true.
So I think we've pretty much stayed consistent with what our thought process was. And the earnings growth of our portfolio was substantially higher than what the Nifty has delivered, because that's exactly how you kind of beat the Nifty.
Yeah,
right?
True. So could there be nuances in these? Like in a sense, let's say, for example, in banks, while banks may not be the ideal place, some of the valuations at the PSU banks, for example, seem very, very interesting. They seem to be at the place that they were, let's say, 2019-20. And then if there is a stage of recoveries, etc., then some of these banks could do well. The guidance from a Bank of India or some of the others for the next 3 years seem very solid.
Yeah.
Is PSU banks an exception to the rule or not really?
No, PSU banks have been an exception to the rule, and they've fared better than the private banks, right? Because for them, the starting valuations were cheaper than the private banks, and they were under-owned. And therefore, the PSU banks really did phenomenally well. Will that also impact the PSU banks overall? I think yes. But again, relative to private banks, because the valuations are still relatively cheaper, I think they have held out okay. Again, but having said that, with a caveat that at least in the first half of the year, while the so-called, a lot of the cyclical and manufacturing driven businesses, some of them at least, not all, did go through a slowdown. Actually, the heroes of the first half have been the banks, because they've at least delivered that mid-teen earnings growth, right? And therefore, sometimes, as I always say in a boxing match, it's quite possible that the opponent wins 2 rounds, while finally Rocky Balboa may win the
eventual bout.
The eventual bout, right?
It's very clear which side of the fight you think banks are on.
No, there's nothing wrong. I mean, I don't have particularly anything against the banks. I just feel that in this cycle, I just feel that the structural move away from savings to financial services is a bigger structural shift.
No, it makes sense. If the average FD saver has realized that it's not working for him or her, then of course smart money.
No, and also I think the fact that the RBI has been a little cautious not to have runaway growth in unsecured loans, right? Because they don't want another credit cycle on their hands like they had previously. That credit cycle was largely because of lending to infrastructure. And this time, we had seen in the past that after COVID, we had a runaway growth in unsecured lending. But look, I mean, the thing is that the most profitable segment for a bank is unsecured lending. Now, if you slow that down, so on the liability side, getting deposits was difficult. On the asset side, if you slow down unsecured lending, which is your most profitable segment, then I think there is a little bit of an issue.
Okay, very quickly, because we're running out of time. What's the Trump trade in your mind in the first 3 months of calendar year 2025? Is it IT? Is it export-oriented? Are you just waiting to see how that pans out?
You know, this is good you asked this, because I find it a little amusing that everybody has decided what Trump is going to do.
But nobody knows.
The whole world has positioned itself for the Trump trade. So, the dollar has strengthened, go back to and invest in America, because he's going to cut tax rates, he's going to make America great again, he's going to put tariffs on China. Some of these things he's been talking about, and I think that a lot of it the markets have already preempted, right? My view is that don't do anything, right? Wait for him to actually do what he wants to do. And then I'm happy to react rather than preempt. Because frankly, we tend to overestimate what can be achieved in the very short term, right? It's not easy to say that suddenly manufacturing in America will boom. Oh, sure. I mean, he wants to get manufacturing back in the US, and it will happen. Probably it'll take a couple of years, because there are a lot of inconsistencies also in that strategy. You want to take tariffs up immediately, but that could mean inflation going up. What could that mean for America? We don't know. You want manufacturing to come back in the US, but you want to tighten immigration. So where are the workers going to come from? You don't want manufacturing to be done in Mexico, Canada, Brazil. So you want to set up tariffs there. So we've all taken a very simplistic view कि यहाँ tariff बढ़ा देगा, immigration बंद कर देगा, manufacturing America में आ जाएगा. It's not that easy, right? So to me, I think a lot of this has their own dynamics and complexity. Yes, I think he's going to change a lot of things in the US, and I'm sure the US will do well. And I always say that when a large global economy does well, it also takes, world growth up. So I'm sure that it's, in some way or the other, it will benefit India as well. But I am not trying to preempt what Trump is going to do and change my portfolio today. I just believe that let him come, let him first do, let us see what he's up to, and then we'll figure out what, if at all, we need to change anything.
Okay. Well, Hiren, always good talking to you. Today is no different. Thanks for taking the time out, and season's greetings to you and yours.
Thank you so much. Happy New Year to both of you and to all the viewers of NDTV. I'm very sure that 2025 will also be very good. We'll take whatever comes in our stride. I don't think there's anything to feel very bearish about, or I think we'll have a normal market.
On that positive note, it's a wrap on this leg of India Market Open. Viewers, thanks so much for tuning in.